If you've been diligently saving throughout your working life, you may be disappointed to learn that at the end of the year you turn 71, you can no longer contribute to an RRSP account in your name. That means no more of those fantastic tax-deductible RRSP contributions. Or does it? In this video, I'm going to talk about a couple of strategies that you can use to make a tax-deductible contribution to an RRSP account even after you turn 71 years old. So if you're turning 71 this year, but you're still working and you're in a higher income tax bracket this year than you expect to be in the near future, then this video is for you. And if we haven't met yet, my name is Mark Walhout. I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so you're alerted when new videos are posted. So before we get started with the examples, I'm going to quickly illustrate how the RRSP transitions to a RRIF at the end of the year 71 and why this date is so important. And I draw this diagram out for a lot of people when we're talking about this transition. The left-hand side of the chart, this is the RRSP phase, the accumulation phase. This is where we're putting money into RRSP. The contributions create a tax deduction that we can use to lower our tax bill today. The idea being that we're going to defer that tax to a later time down the road, eventually when we're retired, where we can make withdrawals from that account and have them taxed in our hands when we're in a lower income tax situation. But something special happens at the end of the year that we turn 71. It's highlighted by this red dotted line here. The government basically says, look, this tax holiday that we've been giving you, this tax sheltered deferral in the RSP needs to stop. It's time for you to now start taking money out of this account and withdraw from it slowly throughout the remainder of your lifetime. And that works in a lot of cases if you're already retired, if you're retired before age 71, the imposition of this age 71 deadline may be somewhat sort of benign to you. Like it works out for your financial planning that it's time for you to start withdrawing from these accounts anyways. But there are situations where people are working or earning high income even at that age 71, and they want to continue to make contributions with their savings because they still anticipate a time down the road where they can withdraw that money at a lower income tax situation, but that day is not yet today. They've reached that age 71, but they still want to keep that tax deferral going. They still want to save into this account. So because you hit the end of that year 71, the government says, look, an RSP in your name, you can no longer make contributions to those accounts. Those accounts need to be flipped over to RRIFs, retirement income funds, which is the other side of the chart that I just showed you. And we need to start taking money out of those accounts. But there are still a couple of options. It doesn't mean that just because you've hit the end of that age 71 date that you're out of options as far as deducting those contributions from your income. And I'm going to give you a couple of examples of how you can use RSP contributions even if you are now past the age of 71. So I'm going to go ahead and I'm going to share my screen and we're going to talk about our first example. And this is an individual. We're going to call him Jack. He's 71 or he turned 71 this year. Jack is single. He has no more RSP contribution room. So even the contribution room that he has for 2023, he used that up. As soon as he got his notice of assessment, he topped up his RSP account. He's going to earn $150,000 of income this year. Now, he has until December 31st of this year to close his RSP account and roll it over into a RRIF. One thing that Jack can do is that he can anticipate what his 2024 RSP contribution room will be. RSP contribution room is 18% of earned income, so up to a certain limit, but in Jack's case, you apply 18% multiplied against his income. So we expect that in 2024, he's going to have $27,000 of new RSP contribution room. So on or before December 31st, preferably now or a few weeks before to give you some buffer, make a contribution, or Jack could make a contribution of up to $27,000 into his RSP before the deadline of December 31st. Now, officially, Jack does not yet have this room, so it's going to put him in a situation where he's going to be over-contributed to his RSP for the period of time between when he makes the contribution now and when the calendar flips over to January, because the new RSP contribution room that he's building up based on this year's income, 2023 income, is not going to be available for him officially in the account until January 1, 2024. So he's going to make an over contribution based on anticipating that he's going to have this room when the calendar flips over. It's going to put him in an over contribution situation. So he is going to have to pay a 1% penalty for about 1 month for the period of time between when he makes that contribution and when the calendar flips over. But if you kind of hold the cost of that 1% penalty up against the tax benefit of that additional deduction that Jack will be able to take next year, the value of that future deduction is going to be higher than the penalty that he'll need to pay, that 1% 1-month penalty on the overage amount. So 1% of $27,000 is going to be $270. He'll pay that one-time penalty for making that over contribution, but he'll have that $27,000 deduction available for him next year, even after he's 71 and even after that account has since rolled over to a retirement income fund. So the form that Jack will need to fill out is called a T1 OVP form. And I'm going to include a link in the description below where you can find that form. This is one situation. Now, a lot of you, I know, do your own taxes. And I'm going to be doing future videos that are talking about how the tax rules are changing in a number of different areas. But this is probably one more reason why I think that it makes a lot of sense to work with an income tax professional. When you're filling out these types of forms, they can get a little bit complicated. This is one where I would say certainly at least talk to your financial planner, but also collaborate with a tax preparer to help you make sure that you fill this form in correctly. So you're gonna fill in, or Jack will need to submit a T1 OVP form to pay a penalty for the overcontribution, but that period of time that he's going to be paying a penalty is only going to be a very short one. And then he's going to have the ability to deduct that $27,000 RSP contribution in the year 2024, the 2024 tax year, or a year later on down the road. If he expects that there's going to be a gigantic bump up in his tax bracket due to a future tax event, he can hold on to that tax deduction and use it down the road if he wants to. So that's one strategy for a single person, how they can make one more contribution before the end of the tax year, even if they don't have the RSP contribution room. The next scenario is where there's a married couple. And so in this case, Jack, he's 71, he's earning $150,000 this year, but his wife, Jill, or his common law spouse, Jill, is only 65. So she still has the ability to hold on to RSPs. So what Jack can do is he can make a contribution to a spousal RSP in Jill's name and have that contribution be deductible in 2024. So one quick caveat here, this is a little bit different than the first example. In this case, Jack would not make this contribution before the end of the year. The room does not yet exist. There's no reason for him to incur the penalty. Jill's only 65. She's under no force to convert her RSP to a RIF. Starting next year, if Jack has money that he wants to set aside into that RSP account, it's going to be the same amount, $27,000 of contribution room will come up from his 2023 income. It'll be available for him in 2024. Next year, he can make a contribution to Jill's spousal RSP. That deduction will go to Jack. He will be able to deduct that against his income. And as long as Jill is under the age of 71, he can continue to make RSP contributions to the spousal RSP and have those deductions available to him on his tax return. So sort of a cool income splitting opportunity and a way to take advantage of Jack's still higher tax brackets until Jill turns age 71. One quick note here is that the notice of assessment that you get from the CRA, after you turn 71, it no longer reports your RSP contribution room. But if you log into the CRA My Account portal, the portal should still show you what your RSP contribution room is. And also you could just call the CRA and confirm it. So if you're over the age of 71, let's say you're in this situation, you're still earning, you're considering whether making an RSP contribution makes sense, but you're not sure what your room is and your notice of assessment doesn't tell you, call the CRA and ask them and they can give you an up-to-date value of what that RSP contribution room is. So what are the key takeaways? So this is the big one. What we're describing here is a tactic, right? So this is a tax tactic that you can use to lower your income tax bill today, tax shelter the growth in that account for the future, and then take the income from that account at a time where you expect that it's going to be to your advantage from a tax standpoint. This is a tactic, but this is not a plan. And any type of tactic like this needs to follow the plan. And what do I mean by that? So this may not work in every situation. Really, we have to look at, what's Jack's current income, what's his spouse's current income, what's their plan for retirement, what kind of income do we need to generate, what's the money for? These are all the things we need to sort of ask ourselves, or someone needs to ask themselves before they decide whether to make these types of decisions, any type of these tax tactics. And so I like to always draw pictures to illustrate, but really the goals is what we're aiming at. We're trying to first establish what are we trying to achieve. And then at that point, we create a plan to achieve those goals. And then as we move through the quarters and the years, we employ tactics. So what I'm describing here with this sort of final RSP contribution, this is a tactic. Is it appropriate for your plan? Not sure. We'd have to talk about what that plan is and make sure that that plan is sort of oriented toward your goals before we think about implementing something like this for your retirement. So hopefully you found this video to be helpful. If you have any questions or comments, leave them below. If you like this video, give it a thumbs up. Scroll down, there's a number of resources in the description section below, including a link to my weekly newsletter, the Retirement Roundup, and a couple tools that you can use if you're interested in learning more about your readiness for retirement. Thanks for watching this video all the way to the end, and I'll speak with you soon. Take care.